Okay, it's okay. Daniel, perhaps we start first, just in case it's too much overrun. Okay, so welcome everyone. Welcome to the webinar organized by DA Global. I'm Devin Ting, Marketing Director of DA International. Today we will talk about the Indian markets. As we all know, the Indian market has rallied to its record high, but is that still a chance or is too high? So we will talk about this topic today, and I believe many of us are not too familiar with these markets. But the lucky thing is that we have Daniel Ang today. Daniel is the CEO of Trader Academic, and he has more than 30 years trading experience. And today he would like to share his insights and knowledge about the market, also including the technical analysis of the two futures products we will cover. One is the Nifty 50, another is Rupee-USD futures products. So welcome, Daniel.
Thank you very much, Steven, and a good afternoon to all of you. Yeah, my name is Daniel Ang, and I'm based in Singapore. And I have been doing this for almost 40 years now, so I've accumulated quite a fair bit of experience. And today the topic will be on India, and in particularly the Nifty 50 index, which is a equity index based on the 50 component stocks of the Nifty. And of course, we will be talking a little bit about the currency, which is the Indian rupee. Now, both India equity markets as well as the rupee is not too much talk about among investors, because most people will be looking west towards to trade the American equity markets as well as in Europe. And in Asia, we know we had a dominant one, which is the Nikkei 225, and of course the Chinese equity markets. Now, India is hardly mentioned as far as investors is concerned, but that is a mistake because India is a big market. In fact, India equity market is one of the best performing market this year, even better than the Nikkei 225. Up to date for the year itself, we are only at a halfway point. We are almost at the end of Q2 now. The Nifty 50 is already up more than 9%. And as of today, this morning, the Nifty 50 is at a record high. So we're going to be talking a little bit about the fundamentals behind the Indian economy, in particularly the GDP, their inflation situation, and what's ahead for India and how it may impact the Indian equity market in regards to the Nifty 50 equity index. And of course, we will also be talking about the currency itself, the Indian rupee. And we also know that this year we can see that most emerging markets, including India, has been on the rope as far as the currency is concerned, largely due to the action or inaction by the Federal Reserve, because the whole world is waiting for the Fed to actually pivot. And until they do so, emerging market currencies, including the Indian rupee, will be falling, and it has been falling for quite some time now. And later on, when I show you the technical outlook, it gives you a sense of whether is it time that the market is about to stabilize and maybe rebound. Okay, now without much ado, let's get into the content and stuff. But just before that, just want to remind you guys that this presentation is not an offer to buy or sell any kind of securities, and definitely it should not be construed as an investment advice. And the trading of any kind of margin product, including futures, options, they do carry risk of loss. So before you attempt to trade any kind of margin products, just be aware that of your own suitability, okay? And of course, do some homework on your own before you attempt to trade any kind of margin products. And of course, I'll be sharing with you my views of the Indian equity markets as well as this currency itself. And just do be aware that these are my opinion, has got nothing to do with the host, which is a direct access, as well as the sponsor for this event. And of course, we will not be responsible for any action that you may take as a result of attending this presentation. And then, of course, this entire content here has not been vetted by the relevant regulatory authority, including the Singapore Monetary Authority of Singapore. Okay, just be aware of this condition here. Now, we want to get into the main thing itself, which is the GDP. Now, of course, the GDP refers to the gross domestic product. It is a measure of the size of the national economy, and it's also based over a period of time. We can see whether the economy is growing or not growing. Now we can see that as far as the major economy is concerned, we have here the United States being the largest economy in the world right now. This is at measured in trillions of dollars. Now, the US economy is worth just under $29 trillion as of the last number that we have. And this numbers is basically, I got this number from the International Monetary Fund, and this is the latest that I have. Coming right behind United States, being the second largest economy, is China, also under $19 trillion. So you can see that China is coming up very, very, very fast over the last 20, 30 years. And right behind in China is Germany at just $4.6 trillion, followed by Japan at 4.11. Now you notice that India is not that far behind. India is just marginally below $4 trillion. And at the rate India is growing, especially over the last few years, we can see that India is coming hot on the heel of Japan. I would not be surprised over the next few years, India may actually overtake Japan as the fourth largest economy. And this is something that we have to watch, because this year, India has officially overtaken the United Kingdom as the fifth largest economy, and it is basically coming for Japan. So we can see India is definitely a growing economy, and we all knew that India right now has already surpassed China as the largest country in the world, being in terms of population size. And this is going to allow India to actually reap the dividends of its young population, because in any kind of economies, not only as consumers but also as a measurement of their workforce, a young economy definitely will be able to catch up to the rest of the world. Now the rest of the world is all facing about the same problem, especially the developed nations, because we can see that the demographic is actually shifting towards having the young people these days do not want to set up their own family. They do not want to have families. They do not want to have kids. So we can see there is a demographic shift right now relative to the emerging economies like India. Now, India, by that definition, is a growing nation because of the size of their populations, relatively young. And like I said earlier on, they will reap the benefit of a growing size of their population being so young. Okay, so this will put India in very, very good position in the years and decades forward. Okay, now when we look at the internal structure of India, now earlier on, the previous chart was to compare where India is relative to the other major economies. Now, when we look inwards, going back to 2013, let me say going back slightly over 10 years, we can see that the Indian economy has been averaging very, very good, above 5%. And that only took a dip in 2020. We all knew what happened in 2020. That 2020, we had the pandemic. And of course, India will not be unaffected. You can see that the following years, India economy goes into a tailspin. It actually registered a negative 5.8%, but it bounced back very, very fast. We can see before pandemic, India GDP on a yearly basis, on an annualized basis, has been growing at a very fast clip. Now, this reminds me of China right after they enter the WTO, and we can see that China also progresses very, very, very fast. It basically tripled the size of the economy. So it looks like India is replicating what China is doing based on their GDP growth. And we can see the rebound from the pandemic itself has been very robust. It registered a high of 9.7% in the whole of 2022. And of course, that has moderated a little bit. And of this year, we are only in we're not even at the end of Q2. We're almost at the end of Q2 at the end of this week itself. And already Indian GDP, based on the data that we see, is likely to register an annualized growth rate of 8.2%, assuming the second half of the year is just as good. So if momentum maintains at the current level, there's a very good chance that India may actually register 8.2%, which is very, very good. Now, when you compare that to China, I think China right now, the economy has slowed down quite a fair bit. They used to register in excess of 6.5% every year. And now we can see that the GDP has actually slid back to about 5%, just marginally above 5%. So we can see based on the growth rate between India and China, we can see India has a lot of potential. And of course, this has got everything to do with geopolitics and the trade war between the collective West and China. So that is having a negative impact on China. But China is still growing, but just not growing as fast. Whereas I think India is taking the opportunity to do a lot of catch up because there's a lot of what we call it de-risking going on. There's a lot of companies they are moving out of China either for political reason or for other factors. They are shifting to other markets, and India is a major recipient of this inflow of what we call the FDI, the foreign direct investments, and of course all the other major economies like Vietnam, Indonesia, all the developing worlds are also benefiting from this shift in production worldwide outside away from China. So India is a major beneficiary of this current trend that we are seeing. Okay, so this will, like I say, will also tends to show up in later days when the data will confirm that India is actually benefiting from this trend. And over here we can see the major contributing sectors to the Indian GDP growth. You can see the large one, the outliner here is construction, and construction means infrastructure. So India, from that perspective, has a lot to build because unlike China, China has been growing phenomenally due to infrastructure building, and India, by comparison, is coming from a very low base, and we can see that construction is a major contributor to the GDP growth, and it will continue to play a major part because most of the infrastructure in India is still based on those that are built during the colonial days. Okay, you can see by extension the rail system is still very much on steam engine, and we can see that the ports buildings are not as advanced as those in China and the others part of Southeast Asia. So we can see that India construction sector will continue to grow. Now, the other one that will continue to grow will be manufacturing as countries are shifting their base to India for manufacturing, whether it is to build microchips or whether it is to build tech equipments. Okay, we can see that there's a lot of Western tech companies are beginning to set up their presence in India, and this is actually going to work into the manufacturing. Now, the other one that is also very prominent is agriculture. We all know that India is very much an agricultural economy, and most of their production is still based on domestic production of food. Okay, so that will remain to be seen, will remain to be prominent. Now, the other one that also stand out is public administration, meaning to say that the government, the size of the Indian government is actually growing, and I wouldn't see it as a good thing because if the size of the government continue to expand at the expense of the other critical sectors, it may actually be a drag. Now, a good example would be United States. The portion of public administration, meaning to say that the portion of the size of the government relative to the overall GDP for America is actually very big and it's growing. Okay, month after month, we can see that their non-farm payroll is very healthy, and when we dig deep into those numbers, we can see that a quarter of new jobs creation in the States is actually government jobs. So this is not good over the long run, because if the size of the government gets too big, it becomes a drag on the economy. So right now, based on the information that we see here, we can see that 60% of the growth in GDP is actually related to services, and which is very similar to mature economies like London, for example, and the United States. But you can see that the one that will really actually anchor in the economy is manufacturing. So there's a lot of scope for India to catch up on manufacturing. Okay, now, these are the future growth sector in India. Okay, there are at least, I believe, 8 of them. Okay, so we'll start with the first one, electric vehicles. Now, India automobile industry is still very much catering to domestic consumption. The biggest, most prominent automaker is Tata, and they don't build anything like what the Chinese are building, which is they have gone almost fully electronic. Okay, meaning to say that this is a sector that will have a lot of potential, because to pivot from gas-powered automobiles to electric vehicle, which is going to be the trend going forward, and we can see that this one has a lot of potential because they're coming from a very, very low base. The entire Indian EV markets was valued at about $1.45 billion just 3 years ago, and it's expected to 10x this number, okay, by the year 2029. So there's a lot of potential in the EV sectors in India. So if you are looking into India, maybe you want to start looking at EV sectors, okay, particularly for India. Then of course the healthcare and insurance market is also growing. Okay, it has reached a size of about $372 billion 2 years ago, and at this compound annual growth rate, which is CAGR of 22%, is expected to continue to grow and grow and grow. Okay, so right now we can see that this is expected to grow another 20% by the end of 2025. The other part will be renewable energy, and now this is a common theme when we look at EVs and as well as renewable energies. We are all talking about going green. So we all know this has been a major theme. Remember when Biden was contesting to be the president, and going green is a big item for him. Okay, so we can say the US is taking is not too into it right now, because they are trying to de-risk from China. China took the story of going green and actually scale it up to the point whereby they now are the major producer of solar panels, clean energy, as well as in EVs. Whereas on the other hand, the West campaign on going green, but they have done very little. So if this trend of going green continues to be a major topics for the global economy, India is also the part of the growth story here. So we can see that as far as renewable is concerned, that India has a lot of potential, because they have not gone in very big way, because they are still very much depending on coal and fossil fuels to power their industries. So this is coming in from a very low. And you talk about hydroelectric plants going to build nuclear plants. India has a lot of potential. And of course, the mainstay of the Indian economy has always been information technology. We all know India produced a lot of engineers in this sector here, so much so that they have a oversupply of engineers in this sector. They are exporting this talent all over the place, including places like Singapore as well as in the United States. So in Singapore, we have a very healthy population of expatriate from India in this particular sector, especially in the banking sector. You can find that a lot of software engineers actually are from India. So this is going to be a growth industry, and it will continue to power India going forward. Okay. Now, the other two major sectors that will also be seeing good growth will be what we call fast-moving consumer goods. Now, fast-moving consumer goods refers to things like if you see like an explosion in the building of let's say shopping malls, for example, you can see that those are the ones that will do very well. Okay, and of course, infrastructure we covered earlier on. Infrastructure is not very focused at this moment in time. It has a lot of potential to grow even bigger. So like I say, the roads and the rail system is still very much not in congruent to an advanced economy. So from India perspective, for them to actually gear on infrastructure, it has a lot of growth potential. Okay, now this is the report that just came out a couple of months back by Deloitte, and we all know Deloitte is a major company that actually has done a lot of all these studies. And as far as their latest report is concerned, they see that the GDP in the India market will continue to expand. You can see that this is a forecast all the way until Q4 of 2026, which is 2 years from now. So you can see that this is an upward trajectory, which is likely to continue to go forward. And of course, all projection will be based on assumption. So here we have 3 major assumptions, one of which is the Federal Reserve will cut interest rates twice this year. And this is still not baked in the oven yet. So we do not know whether the Fed is going to cut rate at all, but this projection is based on the fact that Federal Reserve will have 2 rate cuts this year, and this will actually narrows down the gap between the interest rate differential between Indian interest rates as well as the American interest rate. We already knew as of last month, actually this month, we have seen Canada cut rates by a quarter point. Canada is the first among the G7 nation to actually cut interest rates, and this is on the back of the European Central Bank also cutting rates by a quarter point this month, and that is setting the trend for the other central banks to follow suit. And of course, these two central banks are not the first to cut interest rates. We knew 3 months ago we have the Swiss National Bank taking the ball, leading the way, actually cutting interest rates, as well as the Swedish Central Bank. So right now we have 4 major central banks that has already pivoted. Everybody is waiting for the Fed to do the next cut. However, we are now in June, and it looks like the Federal Reserve had decided that June is not a good time for them to cut interest rate. So they left their interest rate unchanged. And this is actually impacting the other major economies in a big way, because unless the US cut interest rates, what you call the capital flight is going to flow to the United States, because we all know the situation in which the US is operating under. They are definitely in need of tackling their twin deficit. Not only are they talking about a budget deficit, meaning to say that the taxes they collect is insufficient to cover the expenses to carry out all their programs. Okay, so there is a deficit in the budget. And of course, we all know that US has always been the biggest export market to a lot of economies, and it means that Americans are buying more rather than selling to the rest of the world. So that creates a trade deficit. So what we call the twin deficit in terms of the budget as well as the trade deficit is concerned, unless the US starts to cut rates, money and capital will continue to flow to the United States. So we can see emerging markets this year has been on the rope, very much in the fashion of what we saw back in 1997. Now, if you can remember, 1997 is where we have the Asian financial crisis, because currencies of the emerging markets actually collapse. And right now we are seeing almost the same scenario, because emerging markets, whether it's Lebanese pound or Egyptian pound or Indian rupiah, and as well as Indian rupee, we can say that they are all being coming down very, very aggressively. And if this is not arrested soon, and all the hopes are actually banking on the Federal Reserve cutting rates soon, so that they can take the pressure off these emerging nations, what we call currencies. So we have to watch at how the US function going forward. The next window for the Federal Reserve to actually cut will be next month. Next month, the next FOMC meeting, which is the Federal Open Market Committee, is going to be held at the end of July. And if they do not cut by then they will not be able to cut until September. Now, because August, they do not have any FOMC meeting, the next one after July will be September. And September is only 2 months away from the US presidential election, and this is cutting it a little bit too close. So for all we know, this assumption here may be wrong, because the Federal Reserve, if they don't cut soon, then they may not have time to cut, because if they cut too soon near the election, they may be seen to be trying to influence the outcome of the presidential election, something that the Federal Reserve is very mindful that they do not want to be seen in that light. So this is one assumption. The other assumption is that crude oil prices will remain affordable, meaning to say remains below $80 per barrel. We can see that crude oil prices has been coming down since the start of the war in Ukraine. There was a brief spike in crude oil all the way to $130 in the early part of the war in Ukraine in 2022. But since then, it has been sliding. And a lot of that has got to do with the US releasing a lot of their stockpile from their strategic petroleum reserve. And that has kept prices low. Okay. And based on what we can see, crude oil prices has been on the rise as of this week. As of last night, we can see that crude oil prices is back above $80 per barrel. And if crude oil prices in terms of the WTI, which is the West Texas Intermediate, continue to rally beyond $90 per barrel, this assumption will have to be revisited. Okay, there is a good risk that oil prices may stay elevated for a long time, because when you have conflict areas like concerning major oil producing region, then of course the pressure on energy products will actually go higher. Right now we have an ongoing war in Ukraine, and we all know Russia is a major producer of crude oil and natural gas. And of course, there has been trying to sanction Russia in terms of not allowing them to export their energy products to Europe. But you can see that will impact Russia negatively. But overall, overall, we can see that there's a pressure for energy prices to rally. And the other conflict zone, of course, is in the Middle East. We already knew that the war in Gaza has been ongoing for quite some time now. And we can see from July, August, now we are almost into the 1 year anniversary of that. So we can see that if the war in both conflict area in the Middle East as well as in Eastern Europe do not end soon, it will have a negative impact on energy prices. So in my opinion, I think it's quite logical to expect higher energy prices going forward. And of course, India would have to maintain a tight monetary policy, meaning to say that in order not to have Indians sending money overseas, because right now when we look at Indian interest rate, is actually higher than the Federal Reserve interest rate by 1 whole percentage point. And the whole idea here is to make sure that capital do not leave India for United States, because everywhere else you can see that the attraction of parking money in the US dollars is actually very, very strong. So much so that there is a worldwide shortage of dollars right now, and that's only allow people to actually buy more dollars to be parked into US Treasury. And this is actually seeing a global shift in capital into the direction of New York. So this is also one of the reasons why regional currencies has been so weak, because of the interest rate differential here. Okay, so Indian trading major partners, you can see of the total trade that India trade with the outside world, a good chunk of them, more than 50% goes into these few regions. One is European Union, accounting for the biggest pie of their export. So India trades a lot with the European Union, especially after the war in Ukraine. Later on, we will also talk about how the war in Ukraine has actually materially affected India's trade with Russia. Okay, the other major portion is ASEAN. ASEAN stands, of course, for the Asian Association of Southeast Asian Nations, of which Singapore is a member. And a good chunk of their trade is actually with Southeast Asian nations. And of course, we also have China being also taking up a good chunk of those, even neck to neck with the portion for the United States. So India trade a lot with China as well as with the United States, almost equal portion. We can see that China is just marginally ahead of US in terms of export. Okay, and the other one in the Middle East will be with the United Arab Emirates, the UAE, followed by Russia. And Russia is largely due to energy imports as well as their what do you call that, military purchases, because India buys a lot of what you call that, war machines, okay, from Russia. So we can see these are the major trading partner of India. So it is highly unlikely that this composition will change anytime soon, and this is actually growing. Now, earlier on, I did mention that India imports a good chunk of oil from Russia. Now, this is not a case before 2020. Before 2020, we can see that India actually import less than 1% of its energy needs from Russia. But that all changes at after the war in Ukraine started. You can see that the West has actually embargoed Russia in terms of not allowing them to sell their oil to Western Europe, in particularly their natural gas. And the one that we can see that India has found an angle to actually arbitrage this sanction on Russia. Okay, so what Russia did was to buy all this sanctioned oil that the Russia used to export, okay, at a major discount, and then bring it back to India to do some refining. And then of course they add in other crude oils from other places like Saudi Arabia and Malaysia, for example, and they mix those oil up, refine them, and sell back to Western Europe at a premium. So we can see as of now, India imports of Russian oil accounts for 40% from almost nothing. Okay, so you can see that the impact of the war in Ukraine is actually benefiting India in a very, very big way. Okay, so this is a situation that is unlikely to change anytime soon. And not only is India doing that, US is also doing it, ironically, because they are the one that imposed sanction on Russia. But the Western Europe are not able to buy or rather not be able to access this relatively cheap natural gas from Russia. Now they have to buy it from a third party like India or even United States at a premium. So you can see that this is negatively impacting the European Union. You can see that Germany economy is actually deteriorating to a point whereby there's a lot of deindustrialization going on in Germany. German companies cannot survive because their energy cost is now way through the roof, and some of them have decided to move their base to either United States, which has a very constant supply of energy, or nearer to their main market, which is China. So a lot of European countries are actually debasing. Okay, they are actually moved their operation line either to the United States because of constant flow of energy, and the other one is some of them actually started to set up shops in China because China is, after all, their major export market, so they want to be near China. So you can see that the whole of Europe is now negatively impacted, and that is the dynamic that we are seeing right now. Okay, so earlier on I did mention, right, India right now ships about 5 million barrels per day. Just last month, okay, that is a growth of more than 5% month over month. In April, they shipped out something like just under 4.5 billion barrels in April. Right? You can see that actually increased by 5.6% from April to May itself. Now, Russia import also rose because India continued to buy discounted prices in crude oil, and Russia need to sell, because if not, then they do not have revenue, right? So even at a discounted price, Russia is still getting a lot of foreign exchange, and this is the situation right now. Okay. Now, inflation rate in India obviously is following the same trajectory as what we are seeing in the rest of the developed world. If you look at this time last year, India inflation internally is 7.4%. Okay, the most current numbers that we have, which was last month, was only 4.75%. So you can see it has come a long way, and this trajectory is very similar to elsewhere that we see, whether it's the United States or whether it's the UK. We can see that inflation, the headline CPI numbers, year over year is heading down. But we can see that also very similar to what we are seeing in the major economies, that the gradient has actually slowed down. You can see that there's a very, very sharp decline in inflation in the early parts of the fight against inflation. But since then, the gradients has actually slowed down, meaning the internal percentage point in which inflation is coming down, it has not come down very sharply. In fact, it's showing sign that it has plateaued and getting ready to rise, which is the case that what we saw across in Europe as well as in America. Now, will that be the one catalyst that will not allow the Federal Reserve to cut rates fast? That could be the case, okay? But we will have to watch this situation going forward, okay? Because inflation, though, has come down quite a fair bit, but it is still very stubborn. Most of the major central banks are looking at 2% inflation rate. So if you're based on 2%, and I'm sure the Indian central bank, which is the Reserve Bank of India, will also be using the same yardstick to measure when they can actually cut rates. Okay, right now interest rates are relatively high, in excess of 6%. Okay. So this one may have very little room to improve going forward, and that will mean inflation will remain a major concern for central bankers. Now, this is the wholesale price. Now, wholesale price, you can see, is a measurement of the input cost of manufacturing, for example. Okay, if you are a producer, what you pay for in terms of your energy prices, in terms of your labor costs, all these will be built into the wholesale price. You can see that has been pointing upwards. Whether it is food, fuel, or manufacturing, they are all pointing basically in the same direction, which is up. Okay, and this will eventually find its way into the CPI numbers, because input cost goes up. Eventually, all these extra costs will be passed on to consumer, which will also show up in the CPI. So based on the wholesale price we can see so far, it is definitely not a good sign for a lowering of inflation in India for the time being. Okay. So this is the current interest rates. Very much like the United States and the Federal Reserve, you can see that interest rate has stayed stable for more than a year now. At the beginning of last year, it was 6.5%. As of now, this month, it is still 6.5%. So this is deliberate because the Reserve Bank of India, which is the Central Bank of India, cannot lower rates until the Federal Reserve lower rates. Because if they don't, then capital will flow out of India into the overseas, in particularly to New York. So I think the Reserve Bank of India is definitely taking its cue from the Federal Reserve. So if the Federal Reserve doesn't blink, there's very little chance the Reserve Bank of India will actually cut rates first. Okay, because they are price taker. They are not price givers. They don't set the market price for interest rates. Okay. So this is the latest news that came out this morning. It said India external debt stands at $663.8 billion at the end of financial year in March of this year. So we can see that this is not a big number. When you talk about major economies, India, after all, is the 5th largest economy in the world. So they're considered big major economies right now, although they are still categorized as emerging economy. You can see that $664 billion is nothing. When we look at the United States, their national debt stands at just under $35 trillion. So we can see this is, two different categories. So that put India in a very, very good position, because even though there are signs that this debt, external debt, may increase over time, but based on what we've seen so far, this is actually a reduction based compared to last year. You can see that based on their overall debt load, you can see the external debt to GDP ratio is only 18.7. This is not even 20%. Okay, whereas the rest of the major economies are in excess of 100%. Okay, of course, the leader here is Japan. Japan is heavily indebted into the more than 200%. So we can say that that is the situation for major economies. India, based on the debt to GDP ratio, is less than 20%, allows them to actually expand their balance sheet if they need to. Okay, but I think they are very, very prudent. Physically, I think they are very well managed because they do not have excessive debt. Okay, so we can see that this may actually increase. At the end of last year, we can see there was 19%, now it's only 18%. So there is actually a small shrinkage in the external debt in India. So that is the reason why the Indian equity market this morning rallied to an all-time high. Okay, now these are the component stocks of the Nifty 50. The Nifty 50 is actually a composite index. India has a lot of equity index. Sensex is one of them. This one is another major one. Of course, there are other sub-index, but today we're going to focus on Nifty, make up of this 50 component stock as of now. And these are all measured in trillions of rupee. Okay, not dollars, they are in rupees. The biggest one of the 50 component stock of this index is actually this company called Reliance Industry. This is a behemoth, okay, worth almost 20 trillion rupee. Okay, the next is actually Tata. Tata is a major industry, and they have other sub brands, but mostly the one that is listed in this particular index here is under Tata Consultancy. You can see just above Tata Consultancy, you can see Tata Consumer Products, okay, which is nothing compared to this second largest stock in this component, just under 14 trillion rupee. Then, of course, we have the banking side. Okay, the largest one is HDFC, followed by the Bharti Airtel, which is a telecom company. Then, of course, we have ICICI Bank, and you can see this 4 or 5 major component stocks here is actually taking the lion's share of this component stock. And this, of course, is not cast in stone. Periodically, they will change the composition, but as of now, the latest information I have from their website is that these are the component stocks. Okay, and this is the long-term look of the Nifty 50, which is the Indian equity markets. Now, this goes back all the way to 2007. And this is important because this is the period where we have the global financial crisis. Now, when we look back into those days, that period where the market was so stressed during the global financial crisis as a result of the subprime crisis in the States, now when we look back, it's only a little blip. Okay, now, even after the pandemic, there was this major sell-off during the early part of pandemic, which lasts only 1 month. Okay, and then the market has now, look at it, it was under 10,000. Now you can see the index here is actually growing very fast. This is definitely a bull market in any kind of way you look at the market. This market is definitely in the bullish phase. Okay, so this is the index, and earlier on I did mention that the market was I forgot to update this chart here. This was done last week. It was up 8%. Now, as of today, it's up 9%, more than 9%. Okay, so this is a growing equity markets. So this is the result. This is based on the daily time frame, and this is up to this afternoon. You can see that the market have a big sell-off, and this was the result of the election. The market wasn't expecting Modi to lose so much seat. Okay, going into the election, you can see market was actually at all-time high, and when the result came in that he only secured 272 seats, the market sell off in one single day. Okay, one single day it dropped all the way to 21,000 from 23,000. So it dropped more than 2,000 points in one day. And based on this chart, you can see that this chart is the way I look at it is that I need to find directional buyers. There was a brief moment the market actually went into a very deep retracement. Technically speaking, this is where I will be buying, because when the market is in a bull market like this, I will not be able to chase, because this system that I have or I'm using doesn't allow me to chase the market. I only buy on pullback, and this pullback happened so fast on one day. It actually went into what we call a VDR. I call that a very deep retracements. Okay, so if we don't buy here, we don't have a chance. As we can see right now, as of this afternoon, the price is back to just under 24,000. And this will continue to edge higher. My target right now, projected target, is just under 24,800 points. So we still have another 1,000 points more to go before the market hit its projected target, and it may not even stop there. Okay, so this is how bullish the Indian market is right now. Of course, anything can change if the US decided to do something on their monetary policy front, especially if the Federal Reserve cut rates. This will be a rocket fuel that will take equity markets worldwide into fresh all-time high, and this will definitely benefit the Nifty 50. However, if the Federal Reserve decided to hold interest rate at this current level for extended period of time, it doesn't seem to be affecting equity markets around the world, because the market has more or less believed that they are calling the Federal Reserve bluff, meaning to say that they are very confident at some point the Fed will have to cut rates. Okay, so this is the current situation in which we are facing right now. But it's all seems to be working out very well for the Nifty 50. Okay, now this is the 4 hours time frame. Now, obviously, earlier on, I did mention in one single day on June the 4th, the market reacted negatively to the result for the Indian election. It went down to 21,281 and then rebound. Now, this is the futures. This is the futures contract. Okay, so we want to see how this market actually reacted. The target remains the same at 24,800 thereabout, and we can see this as of this afternoon, the market have a new high at 23,842.9. Okay, so again, very, very bullish. Will I buy at this current level? No, I can't buy. But of course, if you can go down to a lower time frame, you can actually find levels to scalp. But always scalp within the green color bar area. If I want to buy, I must buy within this green color area. Prices has already left. So technically speaking, based on how I trade normally, I will not be chasing. Okay, so if you want to chase, you have to have a system in which you can manage the risk. Okay, so this is the other thing that we'll be talking today, which is the Indian rupee. Now, the conventional way of quoting currencies, we have what we call a base currency, meaning this base currency will always be worth one. Okay, 1 unit. So if we call it the dollar versus the Indian rupee, anyway, the Indian rupee, the symbol is INR, Indian rupee. Okay, there is another currency symbol very, very similar to the Indian rupee, which is IDR, which is the Indonesian rupiah. So just be sure that you don't get the wrong symbol for the wrong currency pair. So this is the convention. The dollar is worth $1. How many rupee do you need to exchange for the same $1? So the dollar over here in this currency pair, the $1 remains constant. That left side of the currency, the base currency, will not change. What changes is the currency, or it's called the quoted currency, in this case, the currency on the right. Okay, so it is this currency that is actually moving. This one will stay constant at 1. So we can see that this is the conventional way of quoting dollar versus the Indian rupee, and it has been going higher, meaning to say that the dollar is gaining ground against the rupee, or conversely speaking, we are saying that the Indian rupee is losing ground relative to the dollar. Okay, so this is the conventional way of looking at it. Last I checked, this market is at 83.5466 rupee exchange for $1. So it means to say that the dollar continues to be strong relative to the rupee, and this has been the case year to date. The dollar has gained less than 0.5% against the Indian rupee. So it is not that bad because other currency has performed worse. Okay, but still we can see the trajectory is showing us that the dollar over time is going to consistently stay positive, because this one goes all the way back to 2003. You can see that the trajectory doesn't seem to be wanting to change anytime soon. So the conclusion here is that dollar will remain strong relative to the rupee. Okay. So when we look at the other way of looking at the same currency pair, here you can see that the rupee is the base currency, meaning to say that 1 rupee, how many dollars do you need to exchange for 1 rupee? Here, the rupee is constant at 1. And this is the exchange rate that is quoted in the Singapore exchange. And if you want to trade the rupee, okay, to know whether it's strong or weak, you look at the chart, you know that the rupee is weak, because here it's the dollar that changes. Okay, you require less and less dollar to exchange for the same 1 rupee. Now it's worth less than 0.02 cents, okay, US dollar cent to exchange for 1 rupee. So you can see that this is how weak the rupee is right now. One look at it, you can see that the outright rupee is down, okay, and it will looks like it will be continuing to go down. Okay, very similar. This is a mirror image of the dollar versus rupee. So the way we look at it in the exchange here in Singapore is that this rupee is quoted what you call that, upside down. Okay, but just understand that whatever currency is on the left, that is the base currency. It will always be 1 unit. They don't change. The rates that changes is actually the quoted currency, which is the right currency here. Now, if you look at the rupee India over time, year to date, this is beginning of the year, and this is where we are as of this afternoon. You can see that the market has attempted to rally, but came off in March of this year, and he has basically doing sideways. Okay, so the market has gone sideways. It has stopped falling. At least not materially. We can say that the market is about 0.12 to 0.1204. Okay, so there is a 400 pips difference in terms of the most recent high and low in the rupee versus the dollar. So how do you trade this? Now, this is based on the currency itself. You can see that this is based on a daily time frame. The market is bearish. That one we don't need to see. We already know that it's bearish. And the point of invalidation is 0.1292 unless price breaks above here, which is highly unlikely. Prices will remain under pressure. And we can see the most recent low here is 0.01193, which is a marginal improvement to where we saw, because this afternoon the price was at 0.01197. So it has bounced off a little bit. So this bounce here is what we call a counter trend move. Okay, so for us, if we are going to trade this currency pair, it's too late to sell because the market has moved so far down already. So the opportunity, in my opinion, here is to look for the lower time frame and to look for things like this. This is a counter trend, and when I go down to the 4 hours, you can see 4 hours I can see a lot clearer. Okay, here I have decided that this is the 4 hours time frame, and the most recent low is over here at 0.01193, and we can see here that the price has did a rebound. Okay, and if price do slide back, okay, if the market do slide back in terms of the rupee versus the dollar to anywhere between 0.1193 to 0.1194, which is 100 pips range here, okay, then I am a buyer. I would definitely be interested to buy because I'm trading the counter trend, because the prices has fallen too fast, too deep, and currency do not go to zero. Eventually, there will be a demand for it. So right now, if I where the market is right now, if the price does drop down to 0.01194 to as low as 0.1193, I will be interested to buy. And the point of invalidation is 0.1193. If the price drop below this level here, then I will take my losses and call it a day and try again another time. But because here, if I can manage to buy within this bracket of prices, my risk reward is actually very, very good, because this constitutes a 1 unit of risk. From 0.01193 to 0.01194, that represents 1 unit of my risk. If I'm wrong, I lose this amount here. But if I'm right here, it represents 1 unit of potential gain, 2 unit, 3 unit, 4 unit, potentially 5 units of potential gain. Meaning to say that for every $1 I'm prepared to risk, I have potential to make $5. So this is what we call a superior risk reward ratio. Always look out for your relative risk relative to your potential reward. And if you have a risk reward ratio that is 1:5, this is I will buy the rupee anytime within this bracket of prices. Because if I'm wrong, I lose 1 unit, which is that means to say I can actually be wrong 5 times, and I only need to be right 1 time. Okay, this is another way of looking at the risk reward ratio. All right, I have almost used up my time here. I have 2 more minutes to go, and I will be taking questions. If you have questions for me, either you drop your question into the chat box so that we can take it from here.
Okay, I see one question on the chat box, but before that, Daniel, can we go back to the Nifty 50 slides? I mean the
Okay.
charting. Yeah,
Yeah.
because like you can see, what you can see from this chart, is it seems like the trend of the Nifty 50 is very choppy, goes up and down, goes up and down. So you make a very good point. It's not very wise to chase the trend, right? So maybe if we like to catch up on the trend, we can wait a bit when the price goes down and then we try to get in. But it comes to a question that, so for example, the crash after election. So
Yeah.
it's quite severe. So it's like this kind of case, how we can determine how much, I mean, how much of the drawdown we should consider to get in. Because if we get in a bit earlier, that could cause loss and we may cut the loss and then it rebounds again.
Every trader have their own risk tolerance. Okay. What works for you may not work for all of you. But for me, I have a certain methodology in which I adhere to, regardless of what I trade. Today I'm talking about Nifty 50. Tomorrow I could be talking about the S&P 500. The way I trade is exactly the same. I do not take a lot of risk in my trade. I only look for low risk or trading opportunity. Now, based on what we see here in the 4 hours time frame for the Nifty, this market is obviously on a tear. Short term, there is the possibility the market may extend higher. Okay, but based on what I do not want to chase this market unless I'm trading a much lower time frame. Could I be trading the 5 minutes? I could, okay, provided the liquidity is there and I can define my risk relative to my potential reward. So it's the same approach that I do, but I just do it on a lower time frame. So again, there's no one way of trading, but based on my perspective, this is a market that still wants to go higher, but I will be very leery in jumping in to buy at this current level. I only buy on pullbacks and I only sell on rebound. So based on what we see so far, the market is outside my green color box. It doesn't allow me to chase because I have a certain we call them certain rules that I have to adhere to when I use this system. Okay, I do not buy outside the green color box. And if this is a down market, let me say that this color here instead of green will be a pink color, and I do not sell outside or lower than the pink color zone. So these are basic rules that I set for myself so that I do not be carried away by the sentiment. Right now, of course, by looking at this chart, could I close my eyes and buy? I could, but I can't do it because of the system and the rules that I set for myself.
I got it. So what if it goes back to the green box?
Yes,
So
if the price goes back into my green box, this is the 4 hours. I go down in the lower time frame, maybe the 1 hour, 30 minutes, or even 15 minutes to look for buying opportunity. Okay, now there are many ways you can actually pull the trigger. One of my other criteria beside prices has to be inside the green color box, is that it must give me the signal to go in to buy. Okay, let me say that prices goes into this bracket of prices. There are certain criteria. Obviously, the best place to buy will be anywhere between 20,976 to 21,482, which is defined by the Fibonacci retracement here. Okay, anything below 78.6% all the way to 100%, those are my very deep retracements. I will always buy every single time the market goes into this bracket. But there are times market doesn't go that deep. Okay, so let's say market goes down and hit the 50% mark, then I want, because that's a very sensitive location. So as price move into, let's say, 50% retracement levels, I will look for confirmation in terms of a candlestick reversal pattern. If I'm using the 5 minutes time frame, that 5 minutes time frame must give me a all clear sign to go in to pull the trigger. Because if the market goes down, okay, and then have a reversal bar that is what you call a classical reversal bar, it can be any kind of reversal bars, such as a hammer, for example. If you are familiar with candlestick formation, it can be an inside bar, it can be a bullish engulfing bar. Those are the signal that I need to see on those time frame. Let's say, for example, 5 minutes. Then I will pull my trigger, because by then a low is already in place before the reversal bar happens. So I will put my stop just below the most recent swing low and take my chance. Obviously, this is not foolproof, but it is one of the criteria that I will consider to get in if the market does not fall all the way into the very deep retracement levels. So again, you will have to see each situation. Your toolbox got to be a little bit more expanded, in the sense that you got to have different criteria for doing different time frames and for different situations. The market do not always necessarily will be able to give me such a low price to buy. Okay, and this happens only once. Okay, and if I miss it, I miss it. Then I will not have another chance to do it. So one of the way I overcome this is to not look at one particular market day in, day out. I look at across the market. I look at all markets, including equity markets, equity index markets for not only Europe. I also look at the region, for example, the Nikkei 225, the Hang Seng, the Kospis, and of course, the 3 major equity index in the States. So that is only for equity index. I also watch and monitor, for example, energy prices, whether it's Brent or whether it is WTI or natural gas. I do monitor that. Okay, I also monitor commodities. Okay, this year we can see some commodity has been moving, especially things like OJ, for example, there has been on a tear, and I'll watch those, because any one of these products that I monitor, okay, goes into a situation like this, then for the particular day, I will be trading that particular product. So I won't be looking at Nifty 50 all day looking for a trade opportunity, only if the criteria makes sense. Okay, so that's one way I mitigate it. But that requires me to be watching a lot of market across different time frames. Okay, so I take my cue from the higher time frame. I do not necessarily start my analysis on the lower time frame. For example, I also watch all these products that I just mentioned on the monthly time frame, the weekly time frame. Now imagine if the market goes into a very deep retracement based on the higher time frame, the relevance is very, very powerful. Okay, so this is one way I mitigate it.
Okay, got it. So we can see 2 questions. So the first one is something similar to what we have just mentioned. Is that if he's not too familiar with the Indian market, and he like to try with the Nifty 50, and what kind of trading style he should try. For example, he should try day trade, or he can hold the position for a few days. So
both are equally important. Because if you look at the Nifty 50, it's definitely trending. Okay, and the trending is very clear cut. It's a bull market. So for those who wants to do swing trading, you can consider to hold position. And for those who are more interested in darting in and out, you can also take the chance to, but always stay on the long side of the market, because you can see this market is so strong. Right? The question here is that, do we want to trade with the trend, or do we want to trade counter trend? Okay, when the market is like this so strong, then it will be a lot safer to trade with the trend. So if you're going to be doing intraday, for example, then you got to go down to a time frame which you can understand, using a system that you can understand, and pick your entry levels. Once you are in, you got to tell yourself, okay, I'm not going to go for the whole hogs and I want to ride this market, or I'm just going to go in and out of the markets. So every time you got to find your trading range. Your daily trading range is very important. How much can the market give you on a typical day? Okay, for example, this market go up, let's say 20 points per day. You cannot expect intraday for the market to go up to 30 points because the market doesn't have the range. So again, you got to do your homework, find out what is the average trading range for that particular product here. Okay, and then base your buying or selling decision. If the market have a 18 points or 18-point retracements and the average trading range is 20 points, so you know that you're buying nearer to the lower end of the trading range, and the market goes up to, let's say, close to the upper end of the trading range, then maybe you want to take some profit off the table. And for those who are trading longer term, you want to hold position, again, you have to base your decision on something that you understand. This is my system. I'm not sure what you are using. So you have to find a way you understand your system and decided that once you are in, do you want to hold the position? So everything is very is very correct, very personal. Hope this answer is good for you.
Yeah, that's correct. It's very personal. It really depends
Yeah.
on the risk appetite and the trading style and your skill sets. And the second question is a bit similar to what we have discussed before. So basically, there are two questions under the second question. First is, so is that likely the Indian economy will experience high growth in the near future? And then now the index is at record high. So is it too risky to get in? But I think Daniel has answered this question, right? For you, your style maybe it's not. But it really also depends on the time frame, if it's day trade or on the minutes time frame, that could be possibly, is that right?
Yeah, if you're trading a lower time frame, just make sure that you're always on the long side rather than on the short side. Okay, stay as much as possible to stay with the trend. Okay, so if you understand the market is going to go up, Bruce Lee always say, be like water, go with the flow. Okay, so the market wants to go higher, don't try to go against the market unless you have very good reason. Okay, in their rupee versus the dollar, I'm going against the trend, but I have a basis to do that. Okay, so it's the same thing for the Nifty 50. Right now, there's no counter trend, but if a counter trend should develop, okay, then I will be very keen to trade counter trend because I know the risk I'm taking relative to the potential payout. So if the risk reward ratio makes sense, always be prepared to go against the trend. But by and large, if there's no counter trend, the market is basically going in one direction. Don't try to stand in its way because the market is just going to continue to chart into fresh high position. Okay, so try not to trade counter trend in the very, very trending market. Right now, the Nifty 50 is very, very trending. Okay, there's no counter trend whatsoever. So for now, I think it's safe to be buying, and then where you want to take profit is really up to the individual.
Okay, got it. You just mentioned the currency and the index. I see an interesting phenomenon is the currency trend is going down, but the index is going up. So can we determine that that could be a negative correlation between those two? And um, the currency could be one of the trading signal for the index. Is that we can determine on the trend by the index or by using the currency?
Okay, the exchange rate is a function of whether, because you see, right now the global economy is very global. Capital really do not need to stay in one place. Okay, given the choice, capital are free to flow to places where they can get a better returns. Okay, so right now, based on the fact that the equity markets in India is in a massive bull run, yet ironically, the currency is so weak. And this is not a reflection of India currency being weak, because every emerging currency, emerging economy currencies are all weak at the same time. Okay, so it's not peculiar to just India. Okay, we can see that the Japanese yen is very, very weak over the last 2 years. We can see that the yen has fallen, has lost 30% of its value. But the equity markets in the Nikkei 225 this morning when I checked, has again surged, although it has not taken out the all-time high, but it was trading at all-time high just about 2 months ago. Okay, and right now it is not fallen off a lot. So when we look at the state of the economy and the state of the stock market, now the stock market is not the economy. A lot of people say, okay, if the economy does well, the stock market should do well. Yes, that is largely correct. Okay, but we also know when the economy is not doing too well, but the stock market is high. You don't have to look very far. Look at Europe, look at the DAX, look at the FTSE 100, look at the stock 50. The European economy is struggling, especially the German economy, but the stock index, the DAX, okay, is at record high. So again, this is not just peculiar to India, it's everywhere. So the currency being weak is a function because the US being the dominant economy, the exchange rate is still very high, the interest rate is still very high. So there is the risk that capitals are flowing westwards towards New York. Now, the next thing you want to watch is the war in Ukraine, how it progresses. If the war in Ukraine deteriorates, you can bet your last dollar, the European will shift their money to United States. Because if the war in Ukraine looks like it's going to get out of Ukraine itself, it means to say that it spill over to the other peripheral nations, capital will be the first one to run. Okay, so that will means that there will be further losses in all other currencies other than the dollar. The dollar remains strong because it is a haven currency. Okay, despite all the talks about de-dollarization, dollar is still going to be playing a dominant role for a long time, maybe another 10 years or so. Okay, but we can see the trend. People are no longer trusting the financial system, and definitely not the dollar. So that will happen over time. It will not happen immediately. So right now we can see the rupee is losing a lot of ground. It will continue to lose ground, especially if there's an escalation in the war front. Okay, and India will not be the only, the Indian rupee will not be the only currency that will be on the back foot. Every other currencies, including the Thai baht, including the Malaysian ringgit, they will all be falling. Or it's a matter of who fall faster. Okay.
Okay, got it. Okay, any other questions? So if there are no more questions, then that will be the end of our webinar this time. And thank you, Daniel. Thank you very much. And,
thank you very much for the invitation.
Yep, and I look forward to seeing you soon.
All right.
Yeah, thank you. And
Thank you. Bye-bye.
thank you. Bye-bye.